GM. Welcome to Web3 Academy, your one trusted source to capitalize on the next big phase of the internet. Don't get caught in the hype cycle. I'm Jay Bird, joined by my co-host Kyle Reedhead, and we believe that on-chain value accrual is going to change your world. That's why we're carving a path for doers to confidently build and invest in Web3.
What up, my friends? I'm excited to be here and talk all about on-chain value accrual, something we've been working on a lot, mainly in our pro reports, and it's time to present it further in the podcast.
Where does value accrue on-chain? That's what today's episode is all about. And I just want to highlight a couple of numbers before we jump into this. Did you know that as a result of FriendTech, over $700,000 in fees have been paid to Base? From that, Base has profited $500,000. Now, these numbers are actually from a month ago when we wrote our FriendTech report. So these numbers are more than double that now. So as a result of one app on an L2, they have made likely over $1 million in profit. Wow. And we can see all of that on chain. Did you know when we talk about Uniswap, as a result of all the activity of Uniswap, just shy of $1.6 billion of Ethereum has been burned. And that same number, 1.6 billion in ETH, has been paid to ETH stakers. Wow. Those are big numbers. Now, how do we know those numbers? We know those numbers because of on-chain value accrual. We know them because we can see the way value accrues on-chain from the application layer all the way down to the execution layer. If you understand this, you're going to have more convictions in your investments and how you allocate your capital in Web3. And you're also going to be able to make better decisions as a builder, as an entrepreneur, as a creator in terms of which chains you spend your time on and which applications you spend your time on. So these are very important to understand. And at Web3 Academy, we have a couple of key concepts that really form our hypothesis and our conviction for Web3, why we believe that this is the next big phase of the internet. We talk a lot about verify, don't trust, eyes on chain, always very important. We always talk about don't get caught in the hype cycle. We're focused on sustainable business models here at Web3 Academy. We believe that on-chain is the next online. We talked last week about speculation plus as a key concept for builders in the space. And now this week, we're breaking down on-chain value accrual. About a month ago, when we wrote our first on-chain value accrual report focused on FriendTech. And then last week, we wrote a report focused on Uniswap. So if you haven't gone and read those, you're going to want to go read those. But you want to listen to this episode first because it's really going to give you the solid foundation of understanding this core concept that is so important in Web3. And unlike anything in Web2, basically doesn't really exist. And we'll explain why it doesn't exist and why it's different in blockchain. But before we jump in, there is one thing happening on chain right now that I can tell you that is way better than the online world. And that is the on-chain gift shop, which we just launched last Friday. So right now, if you go and you collect or follow, I'll use the Web2 term, if you follow us on Lenster, we'll put the link in the show notes. It's free. You don't need a Lens handle to do it. And if you go do that, then you can enter the on-chain gift shop. You can get access. And once you're in the on-chain gift shop, you can win prizes this week. And we've got 20 mystery boxes. We've got 3 t-shirts. We've got a one-on-one call with me where I will consult you on your business and so much more in the weekly raffle. Also, if you collect our newsletter, you can get another entry into the raffle and you can get an entry into our weekly cash prize where you could just win straight up cash. Because let's be real, everyone deserves a W when you transact on chain. So make sure you check out the on-chain gift shop. Link is in the show notes. Super excited. We got more weeks coming of more prizes and more stuff that you can win. Make sure you check it out. You deserve a W for your on-chain activity. Okay, let's jump into how do we understand, how do we know that $1.6 billion went towards Ethereum stakers as a result of Uniswap? Let's explain and break that all down But first, we're just going to take a minute to hear from our sponsor. Modern newsletters are built on Paragraph. That's right. Paragraph is a brand new newsletter platform that combines the best parts of Web 2 and Web 3 to supercharge newsletters for both writers and readers. Build a community, not just an audience. Paragraph uses blockchain tech to allow readers to collect and own the words that matter to them. This takes reading a newsletter to the next level. With Paragraph, readers can mint, collect, and show off quotes from their favorite newsletters. This opens new possibilities like creators sharing revenue with fans. I also love their new feature, Paragraph AI. This integrates GPT-4 natively in Paragraph to create, edit, and improve your writing effortlessly with one click. And guess what? We at Web3 Academy are on board and have already moved our content over to Paragraph. We believe this is the future of newsletters because of the profound engagement it creates between creators and fans. So, whether you're a creator, writer, or an avid reader, it's time to check out Paragraph and capitalize on the opportunity of being early. Welcome back. Okay, today we are talking all about on-chain value accrual and how this is going to give you the best conviction in your investments and building in Web3. Now, Kai, to me, you are the inventor of this concept, on-chain value accrual. So I'm going to give you all the credit, although maybe somebody else came up with it. You can tell us. Let's just start at the top. Explain to our listeners who don't understand or don't know what is on-chain value accrual. What is it? How does it work?
Yeah, I mean, definitely, I don't think I was the inventor of this. I think we've just, at Web3 Academy, done a good job of creating nice infographics and images to help people wrap their heads around this whole idea. But people have definitely been talking about this before me. If you're listening on the podcast right now, you're not watching on YouTube, we've got an image up that we've created. You might have seen it on Twitter before, but it's called Value Accrual in Web3, and it basically breaks down the layers of blockchain. And so the starting layer, the top layer is sort of the application layer, right? You could think of this like on-chain consumer apps like FriendTech. You could think of this like DeFi things like Uniswap and Aave, et cetera. You could think of this like Lens protocol or even use cases. It doesn't have to be necessarily apps, but use cases like PFPs, right? It's not really an app, but it's something we do on-chain. Stablecoins are another application layer use case. All in-game assets, identity, all these things are happening on top of blockchains, right? They create transactions, there's volume that's happening. And so this is sort of the application layer where users interact and value is created. Now, what happens is in order to transact and move things on chain, you have to pay fees, right? And so that's like the next layer that's underneath, which previous to L2s coming along, there was just sort of two layers. There was like a use case. We didn't have many back then. But there was this use case, and then you paid fees to Ethereum, Solana, like whatever L1 blockchain. And so you could think of those as the two layers. There's like a settlement layer, settling those transactions, and then the application layer. And so anything that happened on the application layer, there was always some sort of value that was accruing back to these L1s to facilitate those transactions. But now we have sort of another layer that's sandwiched in between those, which is the execution layer. Settlement layers are typically, at least in Ethereum's case, quite expensive, because they're focused around like decentralization. We're not going to get fully into that. And so what we've had to create was another layer in between where it would execute the transactions for much cheaper and faster, and then it would ultimately all settle down on the layer one. And so that gives us sort of our three layers. We have application layer, we have the execution layer, which is your L2s, Optimism, Arbitrum, Immutable, Base, eventually Polygon as it makes its shift. And then you have the settlement layer underneath, which is the L1. And so what happens is for every action that happens on the application layer, there is value that's created that moves to the L2s, and then there's some value that then moves all the way down to the L1s. And so there's always been this discussion of, well, where is all the value going to accrue? Who's going to make it all? Is it the Ethereum? Is it the L1? Is it these L2s? Is most of the value going to remain up on top? And so finally, this year, we've had our ability to actually look at that. And we still don't know like the answers of where all the value is going to accrue yet, but we're able to finally break it down, which is really cool. And so if we think of like when we first started Pro, one of the things that I always wanted and I always compared to was, well, we have these like quarterly reports for companies, right? And so this is cool, right? I guess sort of like every quarter the company comes out, says, hey, here's how much money we've made. Here's what our expenses are, et cetera. And so I was like, oh, when we create Pro, like we could do that, but we can do it anytime we want. We don't have to wait for quarterly. And so like, for everything that's on chain, you can see the revenues that companies have made. You can see the costs they have in terms of what they're paying to the chain to facilitate transactions. You can see how much creators are making in the sense of FriendTech. We'll share that. And so like you can start to see a lot of the value that's flowing within the app itself. Now, not everything is on chain. We don't know how much they're paying employees. We don't know those kind of things, but we can see what revenues were generated, what some expenses are. And then going down the protocol layer, we can see all of it. How much is getting paid to an L2? What is an L2 paying in fees to Ethereum? And so we can just start to understand a lot of concepts and a start of like where the value and how the value is actually accruing across different applications. So it's a whole different world. We couldn't really do this with TradFi, but it's quite interesting to see this happening now and be able to actually look at it.
The first time you look at one of these charts, one of these visuals that we've made, it's like an aha moment for you because there is nothing like this in Web 2 where you could see value accruing in this way. And it also points out the way that Web 3 is different than Web 2. We're building in a composable manner where we are building on top of things that are already built because it's permissionless tech. And you couldn't do that in the Web 2 world. So it opens up so many new possibilities. Kai, in your mind, before we jump into like all the possibilities that this opens up and like why this matters to you and how this helps you be a better investor, why does value accrual in blockchain? What is different? What is happening that allows this to happen?
Yeah, I mean, so first I would say like in Web 2, you could build, there was composability. Like for example, the internet is a protocol and we all have built on the internet. We all use the internet, right? You could think of Ethereum or any blockchain as something similar. It's just a protocol that you can build on top of. But it has the use case of when things are on chain, they can move around frictionlessly, right? Value can move around frictionlessly and permissionlessly. That's not possible on the protocol layers of the internet. We had to build in a new protocol to allow for financial assets to move around, right? And so whereas the internet lets information move around, blockchains let value move around, right, frictionlessly. Now, we didn't have this with the internet, for example, because the internet doesn't have a token. You can't own the internet. No one owns it. So no money is created there. I can't hold, whatever the internet protocol, like I can't hold that token and then make value based off anyone who builds on it and does things with it. The internet just is there and exists, and that's kind of it. But blockchain's a little bit different. We need it to be more decentralized. We need it to be more secure. And so we needed a sort of different form of allowing this protocol to exist, right? And so that's where tokens came along. And so a layer of blockchain, so the settlement layer, let's say Ethereum, for example, has ETH, the asset that goes along with it. It's a native token that goes along with this protocol, and it's what allows the protocol to exist and function, right? So for Ethereum to exist, it must have ETH. And for Ethereum to exist, it must have people staking ETH, right? It's a proof of stake blockchain. If there is no one staking ETH, there is no security to Ethereum, and then Ethereum is useless. And none of these transactions will ever happen on there. Well, they can't happen without that, right? We have this like symbiotic relationship between these holders of ETH, the token, and the users and applications and everything that are on top of Ethereum, whereby like I hold this token and I stake it, and now I can earn from it. And it's almost like a form of UBI, right? Universal basic income. Because we always talk about how Web3 like and blockchain provide equality. Anyone can own anything, right? In terms of like the apps and stuff, you still can't, a lot of apps are still like OpenSea you can't own, but it's one of the biggest ones in our space. But you can own all the transactions that happen on OpenSea. You can own the protocol that facilitates those, right? And so I think that it would be like every user that owns the internet, imagine they could make a percentage of everything that happens on the internet. Like you can't do that. With blockchain, now you can. It's a mind-blowing concept that I actually think it is when we have UBI. I think it's going to come as a result of blockchains and in this form. So it's just a cool way for anyone to own the kind of next phase of the internet, which is very interesting to me. And it all happens because of a token.
So simple when you think about, okay, you have a protocol, you can own a piece of that protocol and provide value to that protocol. In the case of Ethereum, by staking it. There's other ways to provide values to a protocol. In the case of OP, you could provide governance, right? And as a result of that, you can have value accrue to you without you doing any other action, just being a part of the system.
Well, let me explain further like what we mean by this. So when any app has a transaction, there are fees that are paid, right? Those fees, I guess, if it's on top of a layer 2, those fees go to Optimism Arbitrum base, like whatever the L2 is. And then the L2 then bundles up those transactions, sends it over to Ethereum, and takes X% of those fees, and then has to pay Ethereum for those fees. What does Ethereum do with that? Well, it burns 50% of it, at least, sometimes 99% of it, depending on the type of transaction. And so just that burning of ETH drives value to ETH holders because it's making the asset more scarce. Anything outside of what was burnt is going to stakers. And so those who are staking now can earn a percent, almost like a dividend of the stock of ETH. And so like a comparison, sort of a comparison to this, but the only like closest thing I could say is like, let's take Apple, for example. Apple has an app store that makes a shit ton of money, right? I mean, they have many other ways that they make money too, but like, let's just take the app store example because it's similar to Ethereum. But anytime payments are made on that app store, Apple takes 30% of it, okay? And then Apple's like, I don't know, makes billions of dollars in profits per year. If you own Apple stock, it can go up and down, just like ETH can go up and down. But then Apple also decides to pay dividends to the stockholders, right? I think it's like 0.5%, so it's not much, but they pay a little bit to stockholders. And so you're basically, that's technically value accrual from things happening in the Apple ecosystem, right? Now, it's done in a very permissioned way because in order for you to get stock of Apple, well, that's a permissioned share. They could basically take those away at any point they wanted. In order for people to use the App Store, that's all permissioned. Apple decides everything. And then like they don't have to give dividends. They just have decided to do that internally. The board has said, hey, we're going to do this for shareholders. And then every quarter they give that share out. It's all done manually by humans. Ethereum has, you could think of the same setup. It has an app store, essentially. It's not exactly that, but it's somewhat of an app store. It makes revenues from fees, okay? Whether that's from L2 blockchains, whether it's just from use cases right on Ethereum. And then through smart contracts, through automation, it just automatically takes fees from every transaction, and then it automatically burns it and automatically spits it out and gives it to people who stake. And so you have this like whole new way of value accrual, of dividends, of equity, of the whole thing that we have in TradFi, except it's fully automated and fully permissionless, which is just like mind-blowing. And I think the reason that this is cool and what we can start to look at is right now we've shown, and we're about to show you like Friendtech and how that value has accrued to Base and then to Ethereum. We also have one that's gone out on Uniswap. These are just two apps. Let's think about the App Store, which has, I don't know how many apps it has, but millions, I believe. Now let's think about
1 million.
Yeah. So let's think about when Ethereum has millions of apps being used on top of it. They are all generating value to the L2s and then down to Ethereum. It's going to be amazing to see that, because we can actually look at it and create these images and watch it happen on chains. Like that's going to be really cool. But then to help guide your investment thesis and where you're building, et cetera, because you can watch where all the value is moving. You just have never seen anything like it. It's going to be really cool.
Let's jump into Friendtech. For those listening, I'm going to pull up an image on screen, but I'll describe it. If you're listening, if you're watching on YouTube, you can see the image. Before I jump into the specific numbers here, what really stands out to me when we talk about on-chain value accrual is this is a chart about Friendtech, but it could be, as Kai just said, when there's millions of apps, this chart could be about any of those apps. So yes, it's a chart about Friendtech, but it's not about Friendtech. It's about understanding the layers that support Friendtech, that are underneath Friendtech, that are being used in order to enable Friendtech to exist. And that is a key differentiation for me, because right now, if you try to stay on top of every app, every use case in blockchain and Web3, you go insane. Kyle and I try to do it every week and we struggle to do it. There's so much happening, right? So I think that a lot of people in this space, you can get burnt out. If you come in and you're like, oh, I need to know all the apps, all the use cases, all the tools, blah, blah, blah. But you don't. What you need to understand is on-chain value accrual. Because if you understand on-chain value accrual, you don't even care if it's Friendtech, if it's Stars Arena, if it's Post-Tech, if it's Parallel the Game, if it's DraftKings Rainmakers. You don't care about any of that. You only care about how does value from these apps accrue down to the layer 2s, to the holders, to the stakers. And that simple concept allows you to basically abstract away following every app and understanding every app and make easy investment decisions. So that was a key unlock for me.
And to frame that, it's like in the 90s, a lot of people knew the internet was going to be successful, but they didn't know what companies on the internet were successful. And so a bunch of people invested in pets.com, which went to zero. some people also invested in Amazon and some people invested in Google. But there was like, if you look at after the dot-com crash, not many of the tech companies actually made it on to go back to all-time highs, right? But the internet made it, and that just continued to grow no matter what. Unfortunately, at the time, you couldn't invest in that. And so this is why, if you've taken our investing masterclass, I always talk about most of your investments should be in ETH, because it is the one thing that, like, if Web3 makes it, ETH makes it, right? Because it is the king of all of this right now, right? It doesn't matter what app makes it. It doesn't matter what L2 makes it. As long as any of them make it, Ethereum generates value. It means that Ethereum will continue to burn ETH and stakers will continue to get paid, right? And so like that concept removes most risk out of this entire space if you just buy ETH, right? Because you don't have to pick the app that's going to win. You don't even have to pick the L2 that's going to win. It's all accruing back to ETH. Now, we'll touch on these and look at some numbers to say like how much will accrue back there. But ultimately, like, to make life easy, you could just buy that, and no matter what, you're going to be, it's like investing in the internet back in the 90s, essentially.
Mm-hmm. That's insane to think about, that you could invest in the internet. If you could do that, why would you bother investing in the apps? I mean, sure, you take a few flyers, take a few risks, maybe it hit, maybe it doesn't, but there's a sure thing that's available to you. Okay, let's talk about some numbers on Friendtech, because I think there's some really interesting numbers here that tell a story, but also show us what we can learn as a result of looking into on-chain value accrual. So first, I want to focus on the application layer. And let me be clear, these numbers are from August 10th to September 13th. September 13th is when we wrote this report. These numbers are a month old, so you can assume, I mean, with the rise of Friendtech, these numbers are probably double, roughly.
Well, the cool thing is you actually don't have to assume. You can just go to Dune and go to Web3 Academy Pro, and you can watch the live dashboards, and you can get
right.
exactly
check out our dashboard. Yeah.
Never have
to. So we look at the application layer. On the application layer of Friendtech, we have value accruing to two stakeholders. Well, two groups of stakeholders. First, value accrues to Friendtech. They take a fee on total trading volume. They take 5% fee on all trading volume. That has led, as of this report, that had led them to $7.5 million in revenue. A more up-to-date number, I know it's over 20 million now. I don't have the exact number though, but over 20 million in revenue from 2 months of operations. And we can see that. We can see on-chain that they have made revenue. And we talked a bit about, in last week's episode, about how they did this using Speculation Plus as a key concept. And they had fees on speculation. And we think that's a great concept if you're looking for early stage revenue in a business. So you might want to go back and listen to that if you want to understand how they did that. The other important thing to see here is that as of the time of writing this report, over $7.5 million had gone to creators. Now that's to all creators, but because this is on chain, we can even dive deeper into, of that $7.5 million, who did it go to? And we can see that some of it went to different creators and how much each creator has made. But here's the important thing, is we can see how value is accruing to the creators that are basically making this app exist. Obviously, in Web 2, we don't know. We looked at X, who is now providing value to creators on X. We don't know how much each creator is making. We don't know how value is accruing to them, right? Which, if you're a creator, that might impact your decisions to which platforms you spend your time and your money on. Whereas Web3, we can see that, which is awesome. Okay, then we go to the protocol layer. On the protocol layer, a couple numbers I want to highlight. First number is Base. Base is making big fees off of one app, which is really what's incredible to realize. Base has made, as of this report writing, over $700,000 in fees. Now, of those fees, they have to pay out part of those fees to Ethereum through the settlement. And then they also have to pay part of their fees to the OP collective because Base is built on the OP stack. So they don't take all 700,000 of that for profit, but that's their revenue. They take about 400 of that. They take about 500,000 of it for profit. So what is amazing to me to see here is we only need a few apps to really make it, and then value will accrue, right? And this is a great example of that. It's like one app has led to up-to-date numbers, over $1 million in fees have been paid to Base as a result of one app in 2 months. So you can imagine, as Kyle said, when there's millions of apps, and maybe 90% of those apps are small, but 10% of them are big and have millions of users, well, the value that's going to accrue to these layer 2s and to the L1s that support the settlement of these layer 2s, you're talking big dollars.
Yeah, I think the thing that stood out to me when I saw this image is there's like a dotted line box around the application layer, then a dotted line box around the protocol layer. The protocol layer, its revenues always, and this will never change, it makes its money from transactions. So when you're looking at L2s, when you're looking at L1s, the number that matters is transactions. We used to always look at TVL on blockchains. That's actually a pretty useless metric, but that's what everyone's always done because we're so used to DeFi since 2020. And so we always looked at TVL. TVL actually is pretty irrelevant number. I mean, TVL is great in terms of like you need liquidity in one place. And so like the more liquidity there, total value locked, like that app is probably going to be better because there's more liquidity, so it's cheaper, et cetera. But ultimately, it doesn't matter for the revenues of the chain. What matters is transactions. And so if there are apps on chains that have lots of transactions, that is really, really bullish for that chain, whether it's an L2 or an L1. It's all about transactions, right? In the case of Ethereum and its L2s, they're all profitable, right? Every single L2, every transaction is profitable for them because they just take, X% of whatever the revenue they got from that fee, they give it off to Ethereum. And now that transaction itself is profitable, which is great. Solana and others are not there yet because they don't have that sort of setup. They need a lot more transactions to maybe eventually get profitable. But right now they're not there. They're inflating their currency more than they're burning it. Whereas Ethereum is burning more than it's inflating, although in the last couple of days, not so much. But long term, that's what it's doing. So that's the thing to understand the protocol. It's all about transactions. On the application side of it, at least in Friendtech's instance, it's all about volume, right? So transactions don't impact the revenue that creators are making or that Friendtech is making. What matters is the volume of those transactions, right? Meaning if you're a creator that your key is worth $100,000, now that doesn't exist on there, but if it was, one transaction is worth a hell of a lot. But if your key is worth $10, your transaction is not worth much, right? So it's all about volume. And same with Friendtech revenue. They need volume because that's how they make their money. This is the same as like Uniswap, right? Uniswap takes whatever it is, 0.3% or whatever, 0.03% on volume of trades on Uniswap. Transactions are not necessarily the thing that matters. So that's quite interesting. For when we first made this, it's like, okay, it's volume for application layers and then transactions for protocol layer. But then when I thought about it, if you think of Zora, their new model, they're also transactions because they just take a set fee. It's not a percent. It's just a set fee on every single transaction or every single mint, I guess. And then same with Paragraph, which is our newsletter, right? When you collect an article, one of our newsletters, whether it's free or not, they take I don't know, whatever it is, like a tiny fraction of a fee, but it's a set fee. So it just matters on transactions. So Paragraph wants more transactions. They're not necessarily caring about high volume transactions. So there's sort of on the application side, there's two ways you can make money and creators can make money, which is either by volume and taking a percent or by like just transactions and taking a set fee. What will be the better way? No idea. We'll see. I mean, volume, obviously, you can make a lot. When we get to the Uniswap one, you'll see how much the LPs have made, which is in the billions. That's so far ahead of Zora and Paragraph, but those are also two new applications. But anyway, something to think about when you're building an app is you can either take revenues from volume or from transactions.
Yeah, it's great to point out those two levers that you have to play with as you're building in the space. Let's move on to, you teased Uniswap there. Let's move on to Uniswap because these numbers are off the charts in comparison to Friendtech. Kai, I've got the numbers up on screen here. What stands out to you about these?
I mean, so first, the interesting thing about Uniswap is it's been around since 2018. Okay, so it's got the volumes of a bull run, right, which Friendtech does not have, although it kind of looks like it, to be fair, considering those numbers in just 1 month. So Uniswap has what kind of volumes and numbers, transactions, users can happen during a bull run, not just in a bear market. The other interesting thing about Uniswap is it's on 8 different chains. Now, the only ones we showed in our image here are the L2s, so Base, Optimism, Arbitrum. And then you have it also directly on Ethereum. And so we can start to compare how value accrues when there's an L2 versus when there's no L2. Tough to compare this though, because we're looking at all time from November 1st, 2018 to like October 1st, 2023. So the comparisons are very weird. But the interesting thing, I think, is a couple things that I've noticed. When a transaction happens on Ethereum, so directly on the L1, there's the base fee that is burned, right? So you burn a certain amount, and then the tip or the like extra on top of the base fee is what goes to stakers. So in Uniswap's case here, as Jay mentioned at the beginning of this episode, $1.56 billion have been burned and $1.6 billion has gone to ETH stakers. So like about a 50-50, right? Which is quite interesting. So great, you're burning and you're paying to the stakers. But what's interesting is if you look at and actually you'd have to go back to the Friendtech one for this. If we look at the amount that when an L2 is paying its gas to Ethereum L1, it's like 99% is burned of the ETH and like 1% goes to stakers. And that's because L2s don't necessarily need to do a tip or to pay the extra amount. They have their setup is different. And so if we look at here, and on the Friendtech side of things, 254,000 was burned ETH, but only was it like $500 was paid to stakers. So like it's very small. And this is true of all apps on L2. So Uniswap, all of the fees that went to stakers from L2s, like from Optimism, from Arbitrum, from Base, it's like next to nothing. I think like from all transactions on Base, it's like for $50 that have gone to each staker. So it's very low. But then if it's directly on Ethereum, it's much higher because it's just the way the transaction is. That was something that I was a little bit mind blown on. I was like, oh, well, that's a bit worrisome. Is the Ethereum community actually like, do they understand that? And have they figured that out? Because that means like if you're only making like 0.1, when everyone moves to L2s and you're making like less than 1% on your stake, are people actually incentivized to stake ETH at this point? Like this could be a security issue. Now, I'm sure lots of transactions will still continue on the Ethereum L1. So like maybe it's all fine. Again, this is so new, we don't really know. But that was an interesting finding for me. So I'm not sure how that's going to play out, but just something interesting to watch. There's still tons of ETH getting burned. So like overall, I think it's fine. But interesting to see that when it happened, when our analyst first brought that, I was like, nah, this is wrong. You need to go back and fix your numbers. And he's like, no, this is right. And I was like, no, there's no way. I was like, you're 100% wrong. I'm 100% right. And then he went back and looked and he's like, no, you're 100% wrong. I was like, fuck, no way.
God, you're never wrong. What do you mean?
So anyway, that was interesting. And then as I mentioned of Uniswap being part of the bull run, so the liquidity providers of Uniswap, which is where the revenues come from volume, they've made $3.19 billion since the launch of Uniswap. And that's across all chains, not just Ethereum. So that's pretty wild and pretty cool to see. And then interestingly, which I was also mind blown of this and also told our on-chain analyst that he was wrong, Uniswap has made $0. I thought they were taking a cut. It turns out they are not taking anything. So that's also mind-blowing. But again, you wouldn't know this unless you're looking on chain. So really interesting to see.
How does Uniswap have a business then if they're making $0? Did you
investment? So Uniswap has raised, I mean, they have the most users in the entire space. They have billions of liquidity. They have a product market fit. And so I think what they said was their goal was let's get as much liquidity as we possibly can. And so to do that, let's not take any fees ourselves, like other decentralized exchanges probably have taken a cut. So meaning if you're a liquidity provider, you're going to make the most profits if you use Uniswap versus anything else. And it worked. And over the last few years, Uniswap has like a 70% market share, even to this date, even though it's been around for 5 years and there's hundreds of DEXs now. So it's worked. And then the way that Uniswap has survived, well, two ways. One is investment. They've raised like, I think over $500 million in total or something close to that. And then also they launched a token. So they launched the Uni token to help decentralize their protocol, Uniswap's protocol. And so, of course, they airdropped a bunch to a bunch of the users, but they also have whatever, 20, 30% of the tokens, whatever it is, which I think the market cap of Uniswap is in the billions. So they also made a shit ton of money on that as well.
The thing that really stands out to me about both of these charts is how value is always accruing to Ethereum. That is such a obvious thing that you see right away. If you're looking at the Uniswap chart right now, we have Base, OP, and Arbitrum, 3 L2s that we are showing on this chart. And Base, over $200,000 in value accruing to them, $35,000 to Ethereum. OP, over 11 million accruing to them, 7 million to Ethereum. Arbitrum, over 9 million accruing to them, almost 4 million to Ethereum. So you have this constant accrual to the settlement layer, which, as you said, Kai, is not going anywhere is a core part. It's the equivalent of investing in the future of the internet.
Yeah. So, I mean, the other cool thing of this is if you go up to the front or go back to the Friendtech one that I don't think we mentioned is, although Friendtech is on Base and it's accruing value to Ethereum, Optimism is actually taking a little bit of revenue here too. In the sense of Friendtech, it was $72,000 in that first month of Friendtech launching. And that's because Base actually pays 15% of its revenue over to Optimism. Now, why does it do that? Another form of value accrual here is that Optimism obviously has its OP stack where anyone can build a layer 2 using their technology. And so you could just fork it and do that and not pay anything. But Optimism is building more things like bridges and like layers to make this all better and improve the technology. And if you want to be part of that, you have to pay into that fee. You have to pay a certain fee over to Optimism. And so again, anyone that is like lower on the tech stack, Ethereum is the lowest. And so value from everything accrues there. Optimism is quite low, and it's actually lower than many other L2s. Like Optimism is below Base in this instance, right? Base uses the stack of Optimism, which then uses Ethereum. And so like Base is paying Ethereum, but it's also paying Optimism. And so this is the protocol sync thesis that I talk about in the rabbit hole course, which could be another concept that probably we should talk here, but really matters in the on-chain value accrual is protocol sync thesis is this: the most decentralized technologies will always sync to the bottom. And what that means is apps will build on top of the things that are decentralized. Apps aren't building on top of Twitter or Facebook anymore. They used to, and then they realized, oh, they can get rugged and they can change the rules of the game. They can block their APIs, and then your whole business is screwed, right? But if it's something decentralized like Ethereum, well, then you want to build on top of that because you know the rules of the game can't change. And so the most decentralized protocols will sync to the bottom. People will build on top. If those decentralized protocols have a token, value will always accrue there. Optimism has a token and value. It's becoming a decentralized protocol that it's building more things. Value is accruing there. Even Uniswap, it's part of the application layer, but it is a decentralized protocol that's governed by all the users. There will be apps and things that are built on top of Uniswap. There already is. And so I'm sure some sort of values will accrue to that. And so you got to always think of like, what are the protocols that are the most decentralized that are syncing to the bottom of the tech stack? And if those sync lower in the tech stack, like Ethereum, and they have a token that people need to pay to use their thing, then it's going to generate significant revenues. And so I think that's a really good concept to try to like understand when you're investing in this space.
The other thing that's really cool that we can look at is we're just talking about two applications right now. We're talking about Uniswap and we're talking about Friendtech. But obviously there's many more applications built on top of Ethereum. And if you go to ultrasound.money, you can look at the burn of all of these applications. So I've got it up on screen right now. Kai, walk us through how this works and what you're seeing as a result of looking at ultrasound money.
Yeah, this is cool. So when we talked about, imagine what happens when there's millions of apps and millions of use cases. I mean, there's already a hell of a lot of apps and use cases on Ethereum /L2s. And so you can see a burn leaderboard here, and you can go by any time frame. Right now, Jay has the 7-day. And you can see that the app or the use case that's burned the most ETH in the last 7 days is Uniswap. And it's burned 950,000 Ethereum. So almost $2 million worth of Ethereum.
US.
Oh, sorry, $950,000 US dollars of Ethereum. Right. Good point. So almost $1 million. And then second to that is Uniswap V2. So actually the second version of Uniswap, which is funny. The third one is just people moving ETH. So ETH transfers. So it's not even a use case of like any application whatsoever. It's actually just people buying and selling ETH or trading ETH. That's burned $500,000 in the last 7 days. Stablecoins. I always talk about this, how non-speculative use cases are actually going to be a very bullish thing for this space. The fourth highest use case on Ethereum that burns ETH is Tether, right? Which is the USDT. So people just interacting and using Tether on Ethereum is burning $430,000 worth of ETH every 7 days. That's insane. And then you have people who are like, well, L2s are bad for Ethereum, right? They take away from those gas fees. But look at what's fifth and what's sixth. ZK Sync, Starkware, 2 L2s using ZKs that are burning over $243,000 and $300,000 of US dollars of ETH every single 7 days. If you went to maybe 30 and 60, I bet you Base would be up there, Optimism would be up there, etc. And then you have apps like CoinTool. I don't even know what that is, but it's one. You have Banana Gun, which is like a Telegram bot, right? Which is number 8. So like, it's interesting that you have all these different use cases and they're all doing the same thing. They're all generating value back to Ethereum. And they actually categorize it here, which is cool. You have it categorized in industries. So you have DeFi, L2s, NFTs, miscellaneous transfers, and then MAV stuff. And they all can categorize which industries are burning more ETH, which is quite interesting to see as well.
If you're sitting there listening, you're like, wow, this episode is mad nerdy. It's because it is. Like, this is serious nerd stuff. But if you take the time to understand these core concepts, it will push you way ahead of the curve. This is how you stay ahead of the curve. This is how you capitalize on the opportunity of Web3.
Nobody gets this stuff. Not nobody.
No.
A very, very small percent of people understand this. And this is why when people come in the space, they're like, well, what's the new best thing, right? Even if it doesn't accrue any value. And look, value accrual, in a bull market, this stuff might not matter as much. It's all narratives, right? Anything can go up 1 billion % in a bull market, but it's long-term, what's sustainable, what's going to stick around. And it's understanding this value accrual that's really, really going to help you in long-term in this game.
Let's talk about why this matters before we wrap up here, Kai. In your mind, how does this help you make better investment decisions, understanding on-chain value accrual?
So for me, whenever you invest in anything, you want to understand the bottom line. You want to understand the revenues, the expenses, right? You want to understand the supply and the demand. This is what everyone has done for forever in the Web 2 world, right? Not even Web 2, but just in the equities world, is trying to understand how much money are these companies making, how much are they spending, how much profit do they have, and then how much can I make from that? And you can do that live anytime you want, real time. And in the form of blockchains anyway, specifically Ethereum, you just have this whole network that's being built on top of it, right? And that's where most of the users are right now. And this is not to take away from any other chain out there, but what I'm saying is that one app, like let's say Friendtech, takes off, a bunch of liquidity goes onto Base, a bunch of users go onto Base. You now know you have liquidity there, you have a bunch of transactions, you have a bunch of users there. And so you have network effects. So more and more things that launch on that L2 makes that L2 more useful, right? And so because people don't have to bridge if they're already on Base. If you launch your app on Base, well, that makes more sense because there's already a bunch of users there. They already know how to use Base. They already have money there. And so now they can easily go from that app to your app. So you have these network effects. And this is what's being built in Ethereum over the last 7 years, is sort of network effects on Ethereum. And what's great is these network effects don't just drive more builders and more users, it also drives more value to Ethereum, right? And so again, you go back to the App Store comparison of more users that have iPhones, right? More developers that are building on the App Store, it makes that thing more valuable, except that thing was always more valuable just to Steve Jobs and the crew over at Apple, right? Until they went public and you get your little 0.5% dividend, whatever. And this is the first time where those network effects that value can accrue to anyone in the world, right? Mm-hmm. And since day one, you could have done this since day one. Whereas you didn't have to wait 20 years for it to become legit and go public. You could do it today, even when no one really knows about it. And so that opportunity is just massive. And so and you kept saying building conviction. I think it's being able to see that ETH is actually deflationary and that it's truly profitable and sustainable has made, if that wasn't true, I would have a lot of doubts about this space, not gonna lie. Because there's, as much as it has so much promise, a lot of it is a Ponzi's. And then the fact that we have one technology that's not a Ponzi is quite interesting to me. And by the way, Solana is not profitable. And so we don't often talk about Solana much in that regard, but it can be, and I think it probably will be. So I'm not saying that Solana is bad by any means. It has the same thing as ETH, right? Network effects, if people are on its chain, it makes gas fees, it burns Sol 2, which a lot of people don't talk about. Its inflation is way too high at the moment, but that will change. It will get better, and it will have the same sustainability like Ethereum does eventually, I think. We'll see. To me, that this is even a thing that exists is super, super exciting. And so it helps guide investments. It also helps guide, as a builder, it helps you guide where you want to launch your applications, right? Where are the users? Where's the liquidity? Where's the value accruing to? And then that's a big aspect as well.
Yeah, for me, being an investor is a lot of work. And we all have full-time jobs and we're all freaking busy. My investment thesis used to be, well, I'm going to pick the 10 to 100 X's, right? And that's what I tried to do in the last bull run with NFTs. You know what? It's really freaking hard. It is very hard to pick those unicorns. Most of the time, you're going to fail. So, and also you have to be a very active trader. You got to flip constantly. You got to follow every project and you got to you have to take advantage of hype and then get out, right? Whereas for me, my investment plan is long-term, keep it simple, right? And so knowing on-chain value accrual allows me to say, okay, which are the chains that have the most value accruing to them? Great. I'm going to invest in those chains, as Kai said, because of network effects. And I don't need to go pick the next NFT project or the game or the identity platform or the Web3 social platform. I don't need to know which one of those is going to make it because that's hard. So just that ability to keep it simple for me gives me just a sigh of relief that I don't have to follow and pick the winners.
And then there's two other things that I think are really important. One, it's not like buying ETH is like a boring asset, right? Like maybe in the crypto terms, but like the thing still goes up 10, 20x in a bull market, you know? It went from like $100 to like 5,000 in the last cycle. Compare that to any other asset in the world, and that's still insane. And so like, was that not fine? Or did you have to get the 1,000x, right? Which like on whatever the heck that the Axie Infinity or whatever, like, but who knew that was going to happen? And then the other part of it is like, okay, so you can get your 10 to 20x in a cycle on ETH, which is, is amazing. But also you have the value accrual, meaning you're getting a dividend, right? Automatically streamed to you every second of your life. You are making between 3 and 6% on your holdings. And you can see it happening on chain with every single interaction that happens on Friendtech and on Uniswap and whatever. And so like the last year and a half, basically no one has made any money, right? Like if you bought at 3, 4, 5,000, whatever, back in 2021, from 2022, you only lost money. 2023, you were hoping to like maybe get back above water, but most people are still not if they were buying back then. But if you just staked your ETH for the last 2 years and you had 20 ETH, you made a whole ETH, right? You made an entire ETH by doing nothing. And that is only because of value accrual. That is why that exists. And so let's say you have 20 ETH, you made 1 ETH. If you have 40 ETH, you made 2 ETH. You have 60 ETH, you made 3 ETH, and so on and so forth, right? So like those numbers are pretty incredible. And then not to mention you also 10x or 20x or whatever in the next cycle. So it's like, once you understand this value accrual, it's just a complete no-brainer, right? You could try to buy some shitcoin like Pepe and hope that it goes a bit like 1,000x, but even if it goes down, you didn't make any dividends from that. I don't know. It's just so obvious to me.
Just keep it simple, stupid. Well, here's what I want to know. I want to know, you guys that are listening, do you want to see us talk more about on-chain value accrual? And more specifically, which apps, which use cases do you want to see us talk more about on-chain value accrual on? Because we want to dive deeper into, we've done Friendtech, we've done Uniswap, and we're planning to do some more in the future. So please let us know which ones you want to do. Post on Twitter, send us an email, post in our Discord. Let us know which ones you want to do because we want to highlight the use cases and the apps that you guys care about. I also want to know if there's anything more we can do to support you in understanding on-chain value accrual, because this is, as we said, just such a core concept that is so important in your Web3 and your blockchain journey. I hope today's episode helped you all, bring you up to speed on the importance of on-chain value accrual.
Thank you for listening to Web3 Academy, your one trusted source to capitalize on the next big phase of the internet. If you enjoyed this episode, please share it and subscribe or follow so that you don't miss the next one. While you're at it, there's a link in the description for our free newsletter where we provide timely and relevant Web3 insights so you can confidently build and invest in Web3. Make sure to subscribe today. One final note. This podcast is for educational purposes only, and nothing we say is financial advice. Crypto and Web3 are risky, and you should never invest more than you're willing to lose. Thank you, friends, and see you in the next one.